Good morning. I'm Nathan Wardell from Packserv. This morning, you're listening to the Packserv podcast, where we get to speak with industry leaders about trends and challenges and topics shaping manufacturing and packaging today. On today's podcast, we're delighted to welcome Mark O'Donoghue from Finlease. Mark is a recognised leader in financing in Australia and New Zealand. Good morning, Mark, and thanks for joining me.
It's a pleasure. Good morning, Nathan.
I must admit, I'm quite excited to be having a chat with you this morning, not just about Finlease, but about the economy, business, manufacturing in Australia. I don't think I've ever had a conversation with you where I didn't learn something about business and finance and what's happening in economics. So I appreciate you making time for us to have a chat this morning.
Look, that's a pleasure, and we spend all day in that particular space. So it's what we live and breathe, Nathan.
Absolutely. So firstly, to listeners, we'll kick off with who is Finlease and how you got started.
Yes, Finlease has been around for a fair while. That's why I'm probably a little grey. It's a family business. We've been running since 1989, so that's over 35 years. And we've expanded pretty significantly over that period of time, but it's not an overnight success. It's 35 years in the making. We have about 18 offices around Australia with a team, client-facing business writers and brokers of about 50 across that deck. And it covers a huge range of different industries, pretty well any capital-intensive industry. But my sort of heart lies in the manufacturing sector because that's where I started. But I think one of the biggest comments to make is, look, it's certainly not our first rodeo when it comes to the general economy for small business, as well as the equipment and working capital space. Look, we've been really fortunate. Our business has grown pretty exponentially over those 30 odd years. And I'd like to tell you that it's a very complex system, but it's not. All you need to do is do your job well, look after your clients' best interests, and never give them a reason to leave, because you always take it personally. And our business has not only grown from working with clients for 10, 15, 20 years, but they've also been happy enough to refer other peers and friends from either related industries or unrelated industries, to the point where 65 of our new clients every year simply come from word of mouth, which is really rewarding. You know, it's not always easy, but if you stick to your principles about being transparent and always having your clients back, it's a pretty simple process.
Yeah, wow, 65 from word of mouth. Reputations and referrals are so important in business, and that's definitely a testament to you and the business you built and the level of new business you get from it. How did Finlease get started? What was the kickoff point?
Well, you know, it's an interesting story, and I won't go on too much about it, but I literally started as a one band, walking the industrial areas of Sydney, introducing myself as an alternate to manufacturers in the equipment finance space. And that was everything from food and packaging to injection molding, blow molding, sheet metal, rubber, tool making, repetition, precision engineering. And it was a very different landscape back then. You know, this was before the days of mobile phones. So I'd be out there doing meet and greets and introducing myself, and then I'd need to call the office. And the biggest challenge back in the late 80s, if you're in Dunheved Circuit, was to find a payphone that didn't have the cash box ripped out of it, so you could actually make a phone call to either a client or to a financier on a particular transaction. But it was a very, very different time when you didn't have mobile phones, and it's certainly more efficient these days. But it's interesting, Nathan, because despite the fact that we've grown pretty substantially, we still have our team out there doing meet and greets, respectfully introducing themselves as an alternative. You're probably aware we have some pretty amazing Finlease bamboo socks, and I think we've already got 100,000 pairs out into the market, and lots of people coming back to us and asking for 2 or 3 additional pairs because they're very comfortable. So that's really been the start, and the growth just occurred by getting busy and needing additional team members and finding good people.
Yeah,
it's always about finding good people. If you can find good people, and I know that you work with Christos from our business fairly closely, and Christos is just an amazing young fella doing an incredible job in that space. So it's just been organic growth leveraged off good people who share our culture and our attitude towards long-term client relationships.
Yeah, Christos is amazing, really sharp guy, great to work with. So what was the economy like when you first started out?
Well, I've got to say it was a very challenging economy because we had interest rates up around 17%. Now, that was the prevailing rate for not only equipment, but it was also the prevailing rates for home loans. And, a lot of people who don't have grey hair would think that that's almost unfathomable that you could buy a home when you're paying 17%. But I think the reality was that everyone was in the same boat. So whether you were buying a house or whether you were buying a CNC machine or a processing machine, that was what the cost of it was. And over the longer term, they all paid about the same. And then I think over the past 30 years, it's been interesting to see what the averaging has been around rates. When we're in the depths of COVID and there was an enormous amount of government support, the interest rates came down as low as around 3%. But over the longer term, they've been averaging about 6 to 8%. And today, we sit in that range, but with the expectation that we'll see rates drop by about 0.5 to 1% over the next 12 months, because you need to understand that although the RBA rate very much has an effect on variable home loan rates, it also has effect on Treasury, where they're looking to forecast out 3 to 5 year fixed rates. And quite a bit of that forecasting you will see, and the home loans are a good example, you'll start to see from the banks home loan offerings on fixed rate funding for 2, 3 and 4 years at rates below the current variable rate. And all they're doing is pricing in what they expect to be the lower rates downstream. And equipment finance is no different. So we are already starting to see some of that pricing reduction getting priced into the 3 to 5 year fixed rates for chattel mortgages and finance leases.
Yeah, right. So we should still see another couple of rate cuts before the year's out, though, which would be a big relief, I'm sure, to many of us.
I think with all of the turmoil going on internationally, there's a very big case for potentially up to 3 additional rate cuts this year. And a lot of the economists are substantially increasing the percentage potential of that happening, just because we've got to make sure that we don't fall in a hole. When you think about interest rates, they're used as a brake to slow inflation. So if we've got inflation running too high, they'll crank the rates up to slow the enthusiasm of borrowing, if I could use that as the term. And when the economy looks to be slowing, they tend to drop the rates to encourage lending. And the best way to describe it, I remember doing a conference to the mobile crane industry years ago. It was a bit like a drag car. Dropping the rates was essentially putting nitrous into the engine, and increasing the rates was basically letting the parachute go and slowing the vehicle down. And it's really those two levers that interest rates perform in an economy. So I think we're in for some good rate reductions this year. Next year is anyone's guess. It could come down further, just depending on the international economy. But there's an old saying about economists: they're often wrong but never uncertain. So we just have to wait to see exactly what will tease out. So we can only play the game in front of us, and the next 12 months looks very encouraging.
Okay, excellent. That sounds like good news. So, Mark, you started out in 1989. How old were the kids when you started teaching them about money and finance and things like that?
I distinctly remember walking around Lake Tekapo with my son in New Zealand when he was about 10, and I was trying to explain the fundamentals of money and finance to him. And I think he looked at me like I was speaking Esperanto. And I think the biggest message I needed to tell him was that it's not what you earn, it's what you do with the surplus that makes all the difference. And when you're 10 years old or 20 or even 30, you think you've got this incredibly long runway to do what you need to do. And I need to tell you, at 64, it seems like yesterday I was 24. So it goes past very quickly. So it's very important to start to do some of the processes around investment early if you can do it, because, Warren Buffett made a great comment, people try to get rich quick. Warren Buffett has done an amazing job, but his absolute mandate is to get rich slowly. It's all about compound growth and interest, but I won't bore you with too much on that because I certainly bored my son at the age of 10 because, I think he was more interested in Rey Mysterio with the mask on than talking to Dad about money. But anyway, that's what it was.
Absolutely. I know those looks from the kids, though. I think I probably got similar looks from mine as well, trying to explain things like compounding interest to them when they're on the back seat of the car on the way to school. So, what do you think about financial education in school now that we're on the subject?
It's a funny thing. I never thought that I would be in commerce. I did 3-unit agriculture and biology as my majors in my HSC. So I thought that I was going to be on a very different track. And I remember we all had to do some element of commerce in high school. And I found it very boring. Now, I really get a kick out of seeing businesses do really well and what they do to move the levers to achieve that. But it's exciting because it's applied commerce. You can see it tangibly on the ground. So when it came to financial literacy, I think that they just don't teach the basics. When you look at the number of small businesses in Australia, everything from, mum and dad, very small businesses to more significant private businesses that have grown exponentially, and some of them are second or third generation. Those kids just need to be taught the basics. And some of those basics are as simple as it's not the turnover, but it's the leftover that makes a good business. That cash flow and cash flow control is almost as important as profit. You can be billing an enormous amount, but if you can't collect it and you've got to pay wages and you've got to pay rent and you've got to pay mortgages, cash flow is incredibly important. And I think the final thing is, and we absolutely talk in great length to our team about this. We're in finance. We organise facilities for clients. But what we really are is we're a service industry. It's just that the product we provide is finance. So our day's not finished until we've solved the problems for our clients or we've facilitated what they require. And there's plenty of people who can arrange finance, but you need to take it personally. You need to do it really well. You need to be transparent. So we're absolutely a service industry. And I talk to our team about something as simple as a cafe. Go to your favorite cafe. And by the way, you know which one that is because that's where the queue is. The other ones don't have people there for a good reason. But the experience is getting a good coffee. There's a lot that goes in behind that to make sure that the coffee's right, that the barista's skilled, that if you're going to have lunch with them, that the food's fresh and it's well prepared and comes out on time and the staff are pleasant to deal with. It doesn't matter what industry you're in. Most of us are in service-based industries, and I think it's incredibly important that any business recognises that customer service makes or breaks a business. And then, on the financials literacy for school children at a personal level, it's about living within your means. There's way too many people that are maxed out on credit cards who are paying 17 to 21% on credit cards, and they never get over the top of it because they've just spent more than they actually had to earn. Where there's a bit of a saying that, there's some people who have way too much a month left at the end of their pay. They've got to figure out a way to sort of get that right. So live within your means, invest the surplus and leverage. If you can leverage, it's amazing what you can do. And why is that important? I made a comment that, it was only yesterday I was 24 and now I'm 64. You want to get yourself in life to a position where you're working because you want to, not because you have to. Warren Buffett, and I'm sorry to quote him a couple of times, in fact, it was Charlie Munger, his right-hand person, who unfortunately passed away at 98 or 99, said you should always do something that you love doing and you do it whether you are paid or not. And if you can find a career in life that allows you to get out of bed on a Monday morning and think, wow, I actually like what I do, and to get some financial security around you, it will take 10, 15, 20, 25 years, but you've got it. When you start at 30, you can really do it. So I think that the biggest message in my mind is around that. So hope that sort of helps.
Yeah, no, it does. Absolutely. I agree entirely. I think financial literacy is really taught at home and by the example that you set. And teaching kids at a young age, revenue is vanity, profit is sanity, but cash is king. There's so many important things that I learned later in life that I wish I had have been aware of and made aware of and taught at a younger age. So definitely agree. So, moving on to business, what can you tell me about the current conditions in Australia for an SME?
It's funny. It was probably going to be a different conversation if it was a month ago. Um, but sometimes there's a saying, "May we live in interesting times," and I think most of us would say, well, we prefer for it to not be this interesting at the moment because it's pretty unstable. But I think there's some unique opportunities. When something happens, there's always an opportunity if you can figure out where that lies. And I think with the very destabilised circumstance at the moment around world events, and by the way, we're going to expect the share market to be gyrating madly from one side of the ship to the other for the next couple of weeks as they try to understand whether it's bluff or it's going to be there and what the retaliations are going to be. But certainly in the present environment, with the Australian dollar plummeting against offshore currencies, that's going to substantially increase the cost of imported products. So if you've got companies in Australia who can facilitate cost-effective local supply chains and leverage off the back of the sentiment of buying local, which we saw pretty substantially post-COVID. I think it's waned a little bit, but I think these sorts of international shocks do push people back into that. So I think there is an opportunity for SME across so many sectors because we live in this wonderful little country with 25 million people on the other side of the world, and the more self-sufficient we can become, the better it will be for us. And we can sort of watch the battle from the bleachers, and I think that would be the best place to be.
Yeah, well, that does sound like good news, particularly for Packserv. I know that sort of aligns with my own personal views and what it is that we do in terms of being a local manufacturer. But it has been a tough couple of years for SMEs, so that is welcome news. What do you think people need to be focusing on right now in terms of putting an SME in the best possible position?
I talked earlier about cash flow. I think in today's environment, cash flow and the access to cash flow, because it doesn't need to be physically in your account, but you need to have an ability to source it, is probably one of the most important things in the current market. There was an interesting survey that came through yesterday that 18% of SME believe that debt collection is becoming more difficult. Now, that number's up from 5% 2023 and 5% 2024. And it makes sense because you get this knock-on effect. If you're cash flow tight, you're going to slow up paying your creditors. But as a creditor, you're someone else's debtor. So I think it's really essential that you have very, very good cash flow control. Um, and we're seeing it in our sector where traditionally we've always been very heavily involved in equipment finance, whether that be big transport assets or earth moving or manufacturing or packaging and food. But we're also facilitating quite a number of business loans, so more like cash flow loans, including refinance some of the ATO arrears that are coming through because the ATO has become a little more enthusiastic, shall I say, around their collection processes after giving the overall economy a pretty easy run coming out of COVID. So I think cash flow is a very, very important part.
Is that a troubling sign for the people to be financing tax debts?
I'm not going to say so much a troubling sign. I think it was a legacy, and a lot of it was driven also by the accounting fraternity. It was a legacy to say, look, the ATO are being particularly kind. Start to use them as some of your quasi overdrafts, and that sort of was okay for about 3 or 4 years. But now they're starting to tighten. And one of the issues, and I'll probably talk with it further, is when you look at the arrangements that are offered by the ATO on any ATO arrears arrangements. they're looking for a 10% deposit and usually to fully amortise the debt over 12 to 18 months. So it can be quite tough on cash flow. So we've been facilitating either just straight cash flow loans, or we've looked to do purchase and hire backs on existing wholly owned equipment as a function of spreading that debt over a more manageable period at a lower monthly cost on that basis. So there are always challenges in that side, but I think all of us would agree that as we came just to the start of COVID, the initiatives put in place by government were particularly supportive. And I think with any business, and I think we were not immune from this, when things are tracking along well, you can tend to become a little less efficient, a little, overcooked on headcount. And it sometimes takes a little bit of a tougher market to spend a moment to say, well, hang on, we might need to sort of straighten up the deck here a little bit and get our operating rhythm back, which includes things like, is it labour or more productive new machinery that's going to spill to our bottom line? So I don't think it's cataclysmic, but I do think now is a good time for businesses to have a really good look at their structures.
So I think the bottom line of all of that is for SMEs to have access to reserve capital when they need it. And something that Finlease are doing more of is the business loans as well as equipment finance while we wait for the market to recover.
Spot on, including quasi-overdraft style facilities. So you've got to pay down redraw capacity on that side. And it's always about being intelligent about it. You start cascading from what is the cheapest, most flexible form of debt, and then you roll through from there. Then there's 5 or 6 steps in that process, but you've just got to, whether it's us or someone else in our field, you just got to deal with some people who spend their time, it's not their first rodeo. They spend a lot of time doing this, and they can guide the client through that process.
Yeah, it's a partnership to a certain degree. And if you're going to find a good finance partner that can offer you that up-to-date advice, the best possible solutions, the best products, which way to go, those sorts of things. Absolutely. So, Mark, what impact do you think further rate cuts are going to have on FMCG manufacturing in Australia?
I think the impact's going to be twofold. When we had the change to the PAYG tax rates, it essentially meant that most people received about 3% more in their pocket because of the lower tax regimes. But they didn't go out and spend it. What they did was they took the opportunity to pay down their mortgage, to build a defence trench or a buffer zone. And because we'd been in what a lot of people would have thought as being particularly high interest rates, but again, if you've got grey hair, it wasn't that high compared to 17% in 1989. But people were being quite cautious. So I think when people start to see the anticipation and execution of a number of other interest rate cuts, then you will see the change to the positive in consumer sentiment. And that means that they will open up their purse strings a little. And, we all know that when you've got the vast community doing that, then more product gets sold at shelf, more product is used, and the knock-on effect across the greater economy is significant. So I think the first thing is we will see substantial change in consumer sentiment over the next 9 to 12. And then obviously with the cost of debt coming down, that'll just make equipment and working capital facilities less expensive. So it'll help there.
Yeah. So from my perspective, I'd love to see people shift from making price-driven and short-term decisions to making more longer-term quality decisions and reliability decisions that align more with longer-term plans for business. So should people be investing in long-term assets right now in terms of manufacturing?
Look, I think if they have a stable base and they understand their forward landscape, the opportunity to increase cost-effective long-term capacity does basically put a point that now may be the right time to invest in better systems and processes. We recently wrote an article to the woodworking industry, kitchen manufacturers, etc. And we gave them a very specific number, and we said the cost of a new $200,000 machine, fully paid off over 5 years, was less than paying for an additional employee at $1,000 a week. And I think there's lots to be teased out of that. You only have to look internationally. There is more automation going on. There is less labor component. And if you do that automation right, it not only cost effectively increases your production capacity and therefore your margins, but it also has substantial effect on quality because you're removing or partially removing the human factor in that. Now, the dilemma is that labor is basically how am I going to say it? It's a current asset, current liability. You can ebb and flow your labor force. Whereas if you're investing in a $200,000 machine, you're investing in a $200,000 machine. But I think we talked earlier that these more challenging times are an ideal opportunity for companies to have a really good look at the way they do things, because it's times of this pressure that you actually distill some really good outcomes. You're just not going along with the flow, reacting to significant client orders, and you just try to get them filled. You're actually thinking about, okay, how do we make a better mousetrap? What can we do to produce a better product at a lower cost so we've got greater margin and have a more stable production system? So I think it's a good time for that.
Yeah, absolutely. I know a lot of manufacturers at the moment are adopting or considering increasing automation, which comes in a few forms like machinery, robotics, automation, digital, IIoT, Industry 4.0, 5.0, and robots, and all sorts of things like that. So that's absolutely talking to that point you raised about automation and streamlining and efficiencies and quality and those sorts of things. Are there government grants and tax incentives or financing schemes available to help manufacturers invest into this sort of equipment and technology?
Look, there are certainly a number of government grants floating around the place. And one of the biggest problems with government grants is you need to be quite an amazing human being to be able to navigate through all of the things required. And I think there's quite a number of consultants out there that make a living trying to simplify the process. But I think at the most basic level, and it's a bit frustrating, obviously the government has now confirmed that the $20,000 instant asset write-off is valid for the current financial year, which is just interesting because we're now in April. So it's April, May, and June where you've got a clear run to say that you know that you're going to get your $20,000 instant asset write-off. Remembering that's for companies who have a turnover in $1 million or less. So it is a small business write-off. So that's the first thing to be very aware of. The Labor government have confirmed that they're going to extend that into the 25-26 financial year, which is next financial year. Under the Liberal government, what Dutton's saying at the moment is they will make it a $30,000 instant asset write-off, and they will make that permanent. Now, that's a little bit of politician speak, but it may well roll. But I think there's a few other pieces to this that we need to talk on, Nathan. Number one, especially in your industry, it's not about looking at the entire line. Each of the various components of that line are machines in their own right. And if they sit under that $20,000 limit, and you might have 4 of those machines totaling $70,000, they are all eligible for that instant asset write-off. So I think that's very, very important. And I think also, and you only have to look internationally, the cost of really good production and process machinery is becoming very, very affordable. Again, as an old fella, I remember when I was financing engineering machinery back in the 90s, what they would pay for a wire cutter or a sparker rotor was off the charts. And today it's almost a commoditized product. So I think when people look at processes, they should have a really good look at the cost of the machines, because I think that there is some real value to be had in understanding exactly how much it's going to cost them and the benefit. And one of the things that we used to do years ago was, and I gave you the example that a $200,000 machine costs less than $1,000 a week. For those manufacturers, those people involved in food and those people involved in packaging, to really break it down to an hourly rate. So, okay, what's our product? What's it cost for an automated line on an hourly basis? Because you shouldn't be thinking about something at a capital value, although there's some deductibility. You should be thinking about it as if I'm replacing labour, what's it look like? Is it actually a better margin apart from all the other things? And then finally, I do want to say, and again, most people would know this, but these instant asset write-offs are available to companies with a turnover of less than 10 million, as I said. But also within the tax regime, if you have a turnover of less than 10 million, you qualify under the simplified tax system, which allows you to depreciate all your assets at 30% diminishing value. So it's a significant level of tax deductibility, but you have to actively elect to go into the simplified tax system and put all of your assets within it. But it still amazes me that there are companies out there turning over sub 10 mil that are not doing that, and they're paying tax at levels that they didn't need to had they had the right level of depreciation. So it's not our first rodeo. It's what we do all day. So that's just normal to us, but it's just interesting to see that some people don't really understand that.
Yeah, and it comes back to what we were chatting about earlier, and that is partnering with somebody that can offer you good advice and steer you in the right direction into making the right decision at the right time based on market conditions. So look, the big asset write-off is hopefully going to come back after the election, which would be great. But getting back to what you said earlier about financial literacy and a good understanding about business and cash flow, it's a must-have for a successful business. And if you don't have that skill in your business, well, then you should be engaging someone that can help steer you in the right direction. And in that, how can Finlease help in terms of SMEs and manufacturers in Australia?
At a very basic level, we do an enormous amount of equipment finance, as you know. The funding of additional chattels, that's easy. But there's also lots of other things. We do a fair amount of restructuring of debt. And I'm going to try to be really basic about this. If you've got 5 or 6 machines under finance and it's costing you $25,000 a month or whatever that number is, and you're coming towards the latter part of the term, if you're within the last 12 months of that particular debt facility, you can roll that debt over to a much lower monthly outflow. So if you're looking at a substantial improvement in your processing, and that's going to cost you $5,000 or $10,000 a month, there's no point in eating Vegemite sandwiches for 5 years to dine on steak later. So if you can spread your debt by simply rewriting a couple of those other facilities that are coming towards the latter part of the facility, you can bring your overall operating monthly cash outflows to say 15 or high teens, have the new gear in there, and retain your cash. So there's lots of ways to do it. It's just things are very flexible. And again, you just need people to look at it. So I think that's important. We are writing a fair amount of ATO debt replacement at the moment. What's interesting about that is that 62 of SME on the particular survey that I saw yesterday did see an increase in their tax debt over the last 12 months. And 77 of those are in a payment plan with the ATO. Now, again, it's a very aggressive payment plan. You're eating the Vegemite sandwiches to hopefully dial on the steak later. So there is a way to sort of soften that across a broader term, because you've just got to make sure that your operating cash outflow is at a certain level compared to operating cash inflow. And look, one little side note there is, as from the 1st of July 2025, which is only 3 months away, any general interest charges, which is the interest that you are charged by the ATO on ATO arrangements or on ATO arrears, will no longer be tax deductible. So not only are they putting in place some fairly draconian short-term debt facilities, you're not even getting the interest claimable as a deduction. So I think that's going to move a lot more organisations to look outside the traditional ATO. And by the way, although you can finance machinery and do debt restructures with ATO debt, you get the best interest rates and the best terms and conditions where you don't have disclosed ATO debt. So
you wouldn't be recommending you wouldn't be recommending an SME to utilise the ATO debt repayment plan then, because it's not the best market rate. It's not going to be tax deductible, and you can bundle it up and debt recycle it and push it further down the road by putting in a different facility would be a much smarter way to go about it.
And it also presents the client as a better outcome for the underwriter, which will drive better conditions and lower rates. So there's lots of reasons to do that. So I suppose the only final comment I'd like to make, as we've gone through this conversation today, is I think if they haven't already started, now is a great time for businesses to really have a good look at their internal operating rhythms, to see if there's improved efficiencies that can be done there without compromising quality, capacity, or delivery. Always make sure that you've got a war chest available to you for cash flow, just so you don't get compromised. And the other big thing is, we're all small business owners. You want to be on the front foot thinking about ways to improve your business, to assist your clients, not worrying about how you're going to pay XYZ on Thursday. So you just want to get rid of that pressure. So I think now's the time for that to happen. And in these more challenging times, it's a real trigger for businesses to have a good look. So I think that's probably the best advice I can give.
Yeah, looking at cash flow, looking at your debts, looking at your monthly repayments, cash is king, isn't it, at the end of the day?
It is, absolutely. And looking at, especially in labour intensive industries, manufacturing, packaging, food, really having a good look at, can we automate this more? Because if we're going to be super competitive in the local market, as well as potentially in the international market, because for every downside, there's an upside, we've been hammered against the US dollar. I think we're sub 60 at the moment, but there'd be a heap of very happy iron ore exporters, because they always get paid in US. So the Aussie dollar revenue for them has jumped pretty substantially. So, there's always bits and pieces. But our clients are really good at making things, cooking things, packaging things, lifting things, transporting things. Our discipline is around the numbers and how you do it.
Yeah, absolutely. I wasn't aware about the interest on ATO debts coming no longer being tax deductible. So that's certainly not going to be helping any SMEs that are already under financial pressure.
Yeah, absolutely. And that's, why are they doing it? The ATO can tend to want to stampede the herd, if I could say that. And they prefer not to give arrangements. So I think they've just moved the needle a little to help you decide that you don't want to use their arrangements.
Yeah. Mark, thank you so much for taking time to have a chat today. I really appreciate your insight and your experience and your the financial information that you've imparted. I'm sure that's going to be interesting to Packserv clients and anyone else who gets to have a listen to this podcast. I always like having a chat to you. As always, I've learned something new about finance and economics, and I really do look forward to speaking with you again soon. If anyone's got any finance requirements, or if you'd like to know more about Finlease and how they can help support your business, go and visit the website, which is finlease.com.au, and have a chat to Mark or Christos or one of the guys there, and I'm sure they'll be able to help you out. Again, thanks so much for tuning in, and thank you, Mark.
Look, that's a pleasure, Nathan, and I'm delighted to have any initial conversations with clients, whether they be in any state around Australia. I'll certainly have a chat to them conceptually, and then I'll direct the track back and put them in touch with one of our team members that can assist.
Awesome. Thanks so much, Mark.
Thanks, Nathan.
Cheers. Bye.